What's up, family? This is Julius Nyanda with Homeowner Help Radio, where we help you get and keep your financial house in order. Today, our topic is going to be based on conditional loan approval, getting your loan approved by the bank that you're working with. So important of a topic. I can't stress how important it is. A lot of you out there that are looking to buy a home, this is an episode that you definitely want to watch. And keep in mind, lending is extremely intrusive right now. We get so much documentation from you, probably more so than any other institution you've worked with, and it all has to be verified. Your tax returns, your bank statements, if you have any divorce decrees, if you have any death certificates, all these things that we never asked for before, the lending industry are now asking for. So I wanted to take this time to shed some light on underwriting, give you a little bit of background, and help you use the tools from this presentation to help you just better the next transaction you get into, so that you come prepared to the table, you know what steps to look out for, and you're not one of those tragic customers that are at the closing table and about to get their keys or think they're about to get their keys and find out that their loan was actually turned down once it got to the underwriter. So today we're going to be focused on underwriting. Quick shot to people out there that are new to the show or just getting here. We are on right now a tear because we have an initiative to record 50 episodes of Homeowner Help Radio vlog series online in 50 days. So what I've been asking people to do is submit questions and give me comments or give me suggestions for my next episodes. And I appreciate those people that have submitted some great information for us, and we're going to be basing our next set of episodes on that. So I just want to have a little plug out there for our 50 episode initiative. But stay tuned. We got some great slides. I'll see you on the other side.
Welcome to the slide presentation portion of today's show, Episode 7, Getting Approved for a Mortgage Loan. This is part of the mortgage process series where we break down the different steps involved with getting you mortgage financing. Lending landscape. Looking at the lending landscape as we always do, we know that loans are always determined by who buys them, otherwise known as the investor. On the government side, you've got FHA and VA financing. FHA is just low down payment program for first-time home buyers. VA is for veterans that offers up to 100% financing with no monthly mortgage insurance. If it's not government, it's basically conventional, which has two subcategories of conforming and non-conforming. Conforming means that a loan conforms to Fannie Mae and Freddie Mac guidelines. The two major programs are USDA, which offers 100% financing in certain areas with income restrictions, and you have A paper, which is basically your low loan amount, good credit, low debt to income ratio, and a 20% plus down payment. If it's not conforming to Fannie and Freddie guidelines, then it's basically called non-conforming. That's where your Alt-A and subprime loans became popular up and through the 80s all the way to 2006. But when Wall Street backed out of lending, these programs went away. The mortgage process breakdown. The mortgage process has 11 major steps. First is application, where you turn in your documentation and fill out your loan application. After that's done, we pull credit and look at a pre-qualification, which is basically eyeballing the file to determine whether or not everything makes sense to move forward. A good loan officer should be able to turn down the loan at this point or help you get some action steps to move forward. As long as we feel it's going to move forward, we can move on to deal structuring, which is determining the pricing and program and any down payment assistance that may be available. Once I have all the information on the file, I can enter that into the system and generate a pre-approval. Pre-approval is done using an automated underwriting system, otherwise known as an AUS. Keep in mind that even though you're pre-approved at this point, a living, breathing underwriter still must validate that approval. Next, you have disclosure signing, where a file is created and the lender can then legally start the loan process. Disclosures are all about just disclosing the term of the mortgage and doesn't really mean that you're committing to anything. The lender just must do this because the government requires it. The next step is to go in the contract and order the appraisal. Now this is standard. Most people go through the application, disclosure signing, pre-approval, never really having a living, breathing underwriter look at the file, and they sign a contract. The only risk to this is now you're committed to a property, and if you order the appraisal, now you're also spending money on the file. An appraisal can run you anywhere from $475 to $525, so keep that in mind. Next, The file then goes to an underwriter, the living, breathing underwriter, who then takes all of the information given so far, including the appraisal, and then issues a conditional loan approval. The conditional loan approval has two sets of conditions. The first set of conditions has to do with you being allowed to sign your loan documents, and the second set of conditions has to do with the lender actually providing the money or funding the escrow. As long as everything checks out, you can move on to your next step. Now keep in mind, if at step 6, which is the appraisal step, the appraiser comes out to the property and finds that the property either is not complete in the case of a new construction, or that there's issues with the property that need to be fixed, they need to be sent back out for a final inspection. The final inspection can run you $150. So keep in mind, you're probably already spending between $650 and $700 just before you get to step 8, and you still haven't even closed your loan. Once the final inspection is done, conditional loan approval is in, all the conditions have been cleared, now you're able to sign your loan documents. Step 9. At the doc signing is when now you sign all of the pages involved with the mortgage loan. Once the loan is signed, it goes back to the lender, the package goes in, they review it for final review, and then they fund the loan. That's when the lender provides the money. But you're still not out of the woods. At that point, the county still has to put you on record as the new owner, and at that point, you finally own the home. There's also a few tips that I always like to review, but that's going to be for another presentation. But these 11 steps are the basic steps of the mortgage loan process. We're going to be focusing on the conditional loan approval today because I want you guys to try to get this done as early in the process as possible, even before you find the property. If you can get the credit approval, which is basically the portion of your approval that has nothing to do with the property and all to do with your application, that will strengthen your file. Underwriting the mortgage loan. Underwriters are the gatekeepers to the money and the most important people in the transaction. Underwriters basically make their decision based on the 3 C's. The 3 C's are credit, which is your credit scores, your payment history on your accounts, and any public records you may have based on bankruptcy or foreclosures or any liens. Capacity is your ability to repay the mortgage. This is based on your employment history, having 2 consecutive years without any breaks in employment, debt to income ratio, which is the percentage of monthly debt payments to your monthly income, and then how large your down payment is and any assets you have as reserves. That's your capacity to repay the loan. Lastly, we look at the collateral, which is the most important piece. When all fails and you stop paying your mortgage, the lender is stuck with the collateral. So they very much care about the property value, the property condition, and even the occupancy. How will you take title? Are you going to be owner occupied, investment property, second home? Is it a 1 unit to 4 unit? All of that risk is determined when they look at collateral. Underwriters are really, like I said, the gatekeepers. And when you think about it, even back in the day, all the way back to the 1870s, bankers were looked at as the people that lent the communities money. So as one journalist put it all the way back in 1873,
a banker who lives in the district, who has always lived there, whose whole mind is a history of the district and its changes, is easily able to lend money safely there. But a manager, deputed by a single central establishment, does so with difficulty. The worst people will come to him and ask for loans. His ignorance is a mark for all shrewd and crafty people thereabouts.
With this understanding and attitude in mind, underwriters took their responsibility to lend the community's money very seriously. Underwriting became a combination of following the underwriter's guidelines, while at the same time making a personal decision about whether or not the person was a good or bad credit risk. This worked up until about 1974, when the government came out with the Equal Credit Opportunity Act. The industry came under a lot of pressure to avoid discriminatory lawsuits by standardizing. In 1990, Fannie Mae validated the FICO credit scoring system. FICO had been around for years, but it wasn't until 1990 that credit scores were really a part of the underwriting process. Now underwriting went from being a manual underwriting system where underwriters took guidelines and made personal decisions to now being a mix between manual and automated underwriting. This worked well up until about the housing collapse in 2006. This is when lending reevaluated itself and said, You know what? We need a better mix between manual underwriting and automated underwriting and get back to basic underwriting where we verify everything. This is very different from what happened from 2003 to 2006, where if you had a high credit score, you didn't have to turn in much documentation. You had no docs, stated income, stated asset loans, and a lot of those went away. So it's easy to see that the human being, the living, breathing underwriter, is the most important person in the loan process. They're the ones whose name goes on your file well after you've gotten your keys and moved into your home, that if that loan fails, they will ask the question, who underwrote this loan and what were they thinking at the time? This is why it's so important to get your conditional loan approval from that underwriter as early as possible. That conditional loan approval is broken up into two major parts. You have the credit approval, which is your credit and your capacity and has nothing to do with the property. And then you have your property approval, which has to do with property value, condition, and occupancy. So just a quick review, the loan process from steps 1 through 5 involve everything except for a conditional loan approval. You have your application, pre-qualification, deal structuring, your pre-approval letter that you go out and shop properties with, and then you have a disclosure signing that creates a file. But what you're looking to get is your conditional loan approval, and I would suggest at least getting it after your disclosure signing. Once that happens, now you can go into contract, order your final inspections, order your appraisals, sign your docs, fund, and go clear through recording without having any issues about the file that have to do with your credit or your income. This is why it's so important to do this early in the process. Okay, so party notes. From 1934, when the 30-year fix first came out, all the way up to 1974, underwriting was mainly manual. Then it transitioned to being more about automated underwriting systems. Through the housing boom, we learned that lending got a little too automated. People were able to come in with high credit scores and not verify any other aspects of their documentation, including many cases where they didn't verify their income and they didn't verify their assets. Once the boom and bust happened, we knew that we got a little too automated and we had to change things. Post-housing crash brought us back to the basics of underwriting: credit, capacity, collateral. Typically, you go into contract and then get your credit approval. It just depends on your lender. What we're suggesting is that you always get your credit approval as soon as possible. Again, thank you so much for spending your time with Homeowner Help Radio, Episode 7, Getting Approved for a Mortgage Loan.